morning from our global headquarters in New York. I'm Danny Berger, Managed Cranny on assignment. Welcome to Bloomberg Brief. Let's set your agenda. It's decision day. Investors are split over the size of easing. Markets price in even odds of a half-point cut by the Fed. Middle East tensions, thousands of pagers in Lebanon explode, killing several. Hezbollah points the finger at Israel. And as we count down to Powell, we'll catch up with Posen, president of the Peterson Institute, later this hour. It is the 25 versus 50 debate. It is just over even odds that the Fed goes by 50. Quite the change from just a few weeks ago off communication, supposedly from different outlets. I think we'll all be happy when this decision, 2 p.m., is over and done with. We had stronger data yesterday, both retail sales and industrial production, that helped to lift yields only by 5 basis points, but didn't change the odds of what the Fed will do. We're higher by 1 basis point this morning on your 2-year yield. 3.6% is where we stand. Also, when the stronger data came in at 1 point briefly, in this market, we reach another intraday all-time high for the S&P 500. It's somewhat abated. We ended little change on the day. The equal weighted measure of stocks, so did finish at another all-time record. S&P 500 futures little change this morning. Euro versus the dollar, that is stronger this morning, up by 1.1%, up by 0.1%. Euro stronger versus the dollar. That is. Jim Reed of Deutsche Bank writes that for risk assets, this has been the strongest rally going in to a rate-cutting cycle since 1957. Well, Kit Juckes of Societe looks beyond that pivotal decision again at 2 p.m. He rates the following. While the pace of cuts priced into the coming few months seem out of line with the so far modest slowdown in the pace of economic growth, the bigger question is where the destination of Fed funds is, rather than where they start with a hawkish 25 basis points or a dovish 50 basis point one. Kit, I'm pleased to say, joins us now. He's the chief FX strategist at Societe. Kit, I love this because I'm tired of this debate. I want to look beyond it, and that's exactly what you are doing. So why does the destination rather than the journey matter?
All right, narrowly in the foreign exchange market, the destination matters for where the dollar ends up. In other words, the lower the destination, the weaker the dollar will ultimately get. Though, you know, the current main foreign exchange driver is just that the market was so long of a dollar that went up so much that people are hedging their dollar exposures, and it's going down from a great height. But I think the destination matters in that sense. And the destination is important because there's been an assumption during this economic cycle that we're not going back to the kind of the 1% lows or the 0% lows that we've seen in the last few cycles. We'll go to a higher neutral rate. I think that's probably true, but it gets sort of bandied around by lots of people. We're never going back there. We're never going back there. We'll go to 3. We'll go to 2.5. Never going lower. And I think that is we're going to question that, doubt that, have angst over that as this cycle progresses, the rate cutting cycle progresses. Whether we get to a lower low, I think depends on how softly the U.S. economy is going to land. So far, if this was a plane, it's looking like it's coming in for a nice smooth landing. But there's still. You know, we're still in the air, and it's not a soft landing until you've landed.
All right, but Powell's been really hesitant, as have most Fed speakers, to talk about what neutral is, where they want to go. What do you expect from communication from Powell? What's realistic in guiding the market to what the destination might be?
Well, I think we'll get guidance today in terms of what we should expect for the rest of this year, so for the coming months. So not where we'll be in 2-3 years down the road, but I think we will get guidance. I mean, given the backdrop of this 50-25 debate, I think that's important. In other words, you know, if we're going to get a message of, broadly speaking, we're going to get 3 rate cuts, 25 basis points each between now and the end of the year in the 3 meetings we have, then I'm not sure I care whether it's a 50 and a 25 and a hold, or you know, or 325s. That message is the important one. That's the pace you're trying to indicate, and possibly in that sense lean back a little bit against what the market's pricing in there. But the further out projections of where, you know, long-term dots are and things like that, I think those are important for us in the you know, comments and in coming months to see how the Fed wants to steer expectations about where we're going to end up, because I think we haven't had enough of a debate around that yet.
Well, to the point of your first answer, Kit, because the market has come around to this idea of 50, you have seen weakness from the dollar. Euro dollar, I showed it just moments ago, it's at 111. At one point, dollar versus the yen broke through 140. What looks the most mispriced to you with this conversation, with this concentration on 50 basis points worth of cuts?
Look, the most interest rate sensitive currency in the world right now, and they're all much more sensitive to short-term rates than they usually are, but is clearly the Japanese yen, and so that's going to probably react pretty sort of straight line in terms of what happens. I think everything will react, but again, if I had to describe the sensitivities of currencies to 50-25, the starting point is they're more sensitive to where rates are expected to be in a couple of years down the road than they are to this meeting. So the commentary that goes around it from the Fed can make a huge amount of difference and potentially prevent the danger that if they only do 25 after all this hullabaloo, that the dollar sort of spikes back up and risk assets sell off and we all get kind of angsty about the whole thing, which would make me just puzzled, frankly. So I think that's why I think that what Jay Powell says and how he indicates what the path is, to take away this debate about the 50-25 today, once we know what it is, I think that's actually quite important just to get a calmer reaction. Certainly, I can't see that anybody's helped by triggering a violent short covering in the dollar at this particular point in the cycle.
What does it mean, though, if it is a more aggressive pace of cuts, to have the ECB just going 25, you have a BOE that's largely expected to hold tomorrow, you have Brazil talking about hiking rates now. What does it mean to have a U.S. that's kind of going at it alone this time?
Well, I mean, going at it alone, yeah. I mean, that's a sort of a problem that the Fed didn't go in July, and now they're going now. The ECB has gone, so we're just a little bit out of line with each other. It shouldn't make an enormous difference. Again, if you manage the expectations about the path and if everybody's doing so. Now, we know the ECB is going again this year, or we think we do. We think we know the Bank of England's going this year. We just don't think this is the month that's going to happen. As long as you can, as policymakers guide the market, I think that's okay. I don't think the big danger is you accelerate the fall in the dollar. I think at this point, only because it's come down quite quickly, quite a long way already, that I think it's. What you don't want to do, in fact, is trigger just disorderly moves. So, yeah, central banks can't always be in sync, all moving together on the same month. That would seem odd, but they do need to get the focus more on the medium-term path rather than the minutiae of each meeting. We're all in easing mode. The global economy has slowed down. Inflation is coming down, and we're not going to do it quite at the same pace. The noise around, say, 50 basis point moves doesn't help.
Kit, we're also going to get a BOJ decision at the end of the week. I know you are excellent at keeping track of positioning in this market. The BIS quarterly, which I also know you looked at, basically said that the carry trade isn't over yet, specifically hedge funds and those who borrow money internationally. What did you make of that and the danger that this still poses to greater markets?
I think it's true. Look, the kind of the fastest money was out really quickly. Okay, so I don't know. The hedge fund trader who was selling dollar-yen puts to buy calls in the most leveraged version of how you traded the rising. He left on the 1st of August if he wasn't already gone. Why would he do that? The real money, long-term investors are slower, and everybody else is slower after that. And so there will still be some positioning. I think at this point, you ought to get fewer disorderly moves. I thought it was comforting dollar yen went through 140 and bounced back. I don't think it's in Japan's interest for dollar yen to go to 120 in the next few months. That'll disinflate them pretty fast. So I thought the BIS was an interesting and a good analysis of where we are. It didn't alarm me. It did leave me thinking, at 140, whatever we are, do I think 160 or 120 will be seen next? I think we'll eventually see 120. I don't think it has to be disorderly from here.
That's good news. Kit, you're one of the best. Great talking to you this morning. Kit Juckes of Societe. Okay, let's get to some other top stories now that are trending on the terminal this morning. Hezbollah has accused Israel of orchestrating an attack that killed several people and wounded almost 3,000 across Lebanon yesterday. Israel didn't comment on the events, which injured hundreds of members of the Iran-backed militant group. The incident raises fears of an all-out war between Israel and Hezbollah. It's the end of an era. Steve Cohen is stepping away from the trading floor. The billionaire founder, Point72, will no longer be investing clients' money. He will instead focus on driving growth at the hedge fund and mentoring talent. He will remain as the firm's co-CIO. A Novo Nordisk executive says Ozempic is very likely to be one of the next drugs targeted for a cut under the Medicare program. 10 of the world's biggest medicines already saw prices slashed under the Inflation Reduction Act. The current list price for Ozempic in the U.S. is about $970 a month and is covered by most Medicare plans for type 2 diabetes. Coming up, Nippon Steel has more time to try and take over U.S. Steel. We're going to have that next for you. And later in the hour, we're going to count down to the Fed with Adam Posen of the Peterson Institute on why a 50 basis point cut would be a mistake. All that to come on your brief. This is Bloomberg Brief. I'm Danny Berger in New York. Republican presidential candidate Donald Trump vows to revive SALT, the state and local tax break that had been popular among New York taxpayers. The former president capped the tax break during his time in the White House. For more on this, let's bring in Bloomberg's Anne-Marie Horder. And Anne-Marie, this was Trump's policy to limit the tax SALT deductions. So why the possible backtrack?
Right. And we've already heard from people like Senator Schumer, who I spoke to recently at the DNC, saying they want to make sure that they sunset that cap. This is a pure play, really, I think, for New York, and not really for Trump. No one thinks that Trump is going to win New York State, but potentially very swing district on Long Island, where he's going to be speaking tonight. This is New York 4. It's currently heard by Congressman Anthony D'Esposito. He's in a very tight race. He's one of the individuals that won in 2022 during the midterms that flipped the House red. So now Trump is coming out and saying that he wants to work across the aisle. Work with the New York governor, I guess. Work with Democratic senators. Remember, the SALT cap really penalizes blue states. It would help in places like New York, California, and Illinois.
So what, it's more of a down ballot play? Is that kind of what you're saying, to help senators, representatives?
Well, I think what you see in this election, whether you're looking at Kamala Harris's campaign or Donald Trump's campaign, is what I call an Oprah Winfrey election in terms of everyone seems to be willing to get a tax cut. It seems that everything is under negotiation. But right now, these are just campaign ideas. Depending on the composition of Congress and also who's in the White House, we'll have a clearer picture on how this tax fight is really going to go down. But regardless, there will be a tax fight next year because the Trump-era tax cuts, they will be sunsetting. A lot of those provisions will be sunsetting by the end of 2025.
One policy that they're seemingly not trying to tackle now but kick down the can is U.S. Steel and Nippon Steel are reporting, people familiar, you and the team, talking to people familiar, saying that they're going to push the deadline for this essential application until after the election. What's the thinking behind it?
So basically, this restarts the clock for CFIUS to review Nippon Steel's acquisition, this $14 billion acquisition they want for U.S. Steel. So politically, this means that kicking the can down the road, as you say, we will likely not see a decision then before November 5th. And this becomes really political because the fact that Kamala Harris and Donald Trump are both spending a ton of time, a ton of money. Pennsylvania is a must-win for the Harris campaign. President Biden has come out and said it should remain domestically owned, and President Trump said in February that he would outright block this deal. But parking the politics aside, how CFIUS works, and there's been a lot of reporting that individuals from the State Department and individuals from the Department of Defense don't agree right now on the national security concerns or view it differently. So the tea leaves is that there's no consensus yet on CFIUS. And also, if they extend this review and give Nippon Steel more time, if there was to be a legal battle, potentially the blow wouldn't be as harsh in the sense that they gave Nippon Steel another 90 days to come back.
Anne-Marie, thank you so much. You can catch Anne-Marie on surveillance in just an hour's time. Anne-Marie Horder. Okay, coming up, Google wins its fight with the EU over $1.7 billion fine. That's up next. It's your Bloomberg Brief. I'm Danny Berger in New York. Google has won its fight with the European Union over a $1.7 billion fine. The EU's antitrust regulator had imposed the fine after finding that Google abused its dominance via its AdSense advertising service. Bloomberg's Oliver Crook joins us in Berlin on this. Oliver, there had been a lot of fights with Google, with other big tech and the EU. What does a win mean for Google in this case?
Yeah, so they're back in court this week. And reminder, just last week we had some verdicts coming from the European Court of Justice going in the other direction, both for Apple and for Google, to the tune of $14 billion for Apple and something close to $2.5 billion for Google. Now you get a bit of reprieve there in the European General Court. Basically, this was a case about it being very difficult for third parties to advertising to come up on Google search. The EU Commission said this is anti-competitive. This has now been struck down. And Google was really sort of explosive in their language on this. They were saying that basically the EU was using quasi-criminal level fines against them. It was way out of proportion, saying that the case had a ton of holes in it. But we should say that this is the European General Court. This is not the final word on this matter. The ones that we got from last year were at the highest court of Europe, the European Court of Justice. This could still go there. But again, a bit of reprieve from big tech out of Brussels this week.
Well, we know the EU antitrust chief, Margrethe Vestager, has piled on billions and billions of fines on some of these U.S. tech companies. But with her second term almost over, what could a new regime, what could a new antitrust chief mean for some of these companies?
Yeah, Danny, this is really interesting. So Margrethe Vestager has nailed about $10 billion worth of fines towards Google. It's closer to $20 billion when you think about Apple. And she is now ending her second term. So this is really monumental. This is one of the most important and powerful roles within Europe. And we got from Ursula von der Leyen the name of the person who will be replacing her. So this is a name you might want to familiarize yourself with. That is Teresa Ribera. She comes from Spain. She is now heading the Competition Commission. What is also interesting, Danny, is that von der Leyen has also combined both the anti-competitive part of the commission with the pro-competitive, i.e. the sort of antitrust side of things and sort of regulating big tech, with how to make Europe more competitive and how to build and develop their own kind of big tech companies. So there's a balancing act there. We should also say that as Vestager leaves and you get the new person in, there are now new tools that exist that did not exist for Vestager under any of these lawsuits that we've been talking about the last 2 weeks. The Digital Markets Act, that is now a tool that Ribera will have to work with as she thinks about this. And by the way, Vestager, on her way out, she spoke to the FT this week saying that basically as she ends those two terms, really warning against dialing back that regulation, because once you open that Pandora's box and these tech companies get a foothold within Europe, there is no closing it.
Oliver, we appreciate it. Bloomberg's Oliver Crook. Now, in another corporate win, BlackRock and Microsoft are teaming up on one of the biggest efforts to bankroll the building of data centers and energy infrastructure, things that are pivotal to the AI boom. And the companies will seek $30 billion of private equity capital, rather. The money will then be leveraged to as much as $100 billion in potential investments. Bloomberg's Tom Metcalf joins us for more. Tom, just what are the details of this? I mean, it's a lot of money and some very large companies.
Yeah, there's a lot of money, large companies, and it's one of those fascinating structures which I think speaks to just how much money they're looking to deploy. So this is going to be a partnership between, these household names, right? Microsoft, BlackRock, and then over in Abu Dhabi, MGX, which is basically going to be a conduit for, I assume, a huge amount of sort of sovereign wealth from that region. And it's really interesting to me that wording you picked up about, they're seeking to, deploy basically $30 billion of private equity money, which suggests to me is not going to be just these three putting together the $30 billion. They're going out there, they're seeking investors, they're seeking shareholders, which again speaks to just the enormous amount of money they're looking to get into this thing.
Yeah, and I'm curious if it does something to sort of like revive the AI trade in public markets, which has been languishing. Tom, I spoke to Apollo after they backed Intel in a big way in terms of getting a data center up and running. Microsoft and Brookfield, they've also signed the biggest clean power deal earlier this year. In talking to these folks, you get the idea that there's not even enough money out there in the world to finance the kind of changes that are needed for AI and clean power. So how are these firms thinking about financing what's going to be the future and what many places are behind on?
Yeah, I think that's the sort of fascinating thing about this trend is just the sheer sort of absolute figures involved, and that is why, in terms of how they can find the money, they need to partner with people. Once upon a time, right, Microsoft would have probably just done this solo, perhaps. But now, they need to get that money from Wall Street, hence BlackRock. They need to get that sovereign wealth money as well, hence MGX, the Abu Dhabi vehicle. So, and I think it speaks to, it's not just AI, right? It's all these big transitions, as you say, the climate transition, the energy transition. We're talking billions, and you had Draghi coming out and say, we're looking for 800 billion of investments. And really, the only way the private markets can get involved is obviously by looking far and wide for that, tapping as many investors as they can, and also, one would suspect having some government sort of support in some way.
Yeah, a lot, Inflation Reduction Act in the U.S. A quick check on your bond markets this morning as we're just, 7, 8 hours, 9 hours away from the Fed decision. 2 p.m. is your time. I can't do mental math this morning, apparently. Yields are higher across the curve by as much as 1.8 basis points for your 10-year yield. On the front end, they drifted higher by 5 basis points yesterday. After stronger retail sales data and production data, still expectations for a 50 basis point cut are more than 50%. Coming up, we're going to catch up with Peterson Institute's Adam Posen on just that. He says a 50 basis point cut by the Fed would be a big mistake. We're going to break it down coming up on Bloomberg Brief. Stay with us. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manish Cranny is on assignment. Let's set your agenda. It's decision day. Investors are split over the size of easing. Markets price in even odds of a half-point cut by the Fed. Middle East tensions, thousands of pagers in Lebanon explode, killing several. Hezbollah points the finger at Israel. And as we count down to Powell, we're going to catch up with Adam Posen, president of the Peterson Institute, just minutes away. First, a quick check on your markets this morning. It is the 25 versus 50 debate. We are over just even odds for 50 basis points of a cut, which means congratulations, Fed. You will surprise the market either way you go. Stronger retail sales data and production led to 2 years ending the session by about 5 basis points higher. A little change this morning, up by 1 basis point. Meanwhile, equity futures are up 0.1%. At one point yesterday, we reached an intraday high. It ended the session little change, though the equal-weighted version of the S&P 500 did end at another all-time record. Meanwhile, your euro versus the dollar, that is stronger, 0.2%. 1.11 is where we stand on euro versus the dollar. So yes, it is 25 versus 50. I'm sure some people are looking forward to having that settled later today. Here's what some of the biggest market voices are saying about that debate.
25, 50 basis points.
25 or 50.
25 or 50.
It doesn't make a difference.
It's not going to be earth-shattering.
They're a long way from neutral, but I don't think they're going to do 50.
They're losing sense of the bigger picture. 25 basis points is going to be would be the right thing to do.
If they do 25, they'll lather it on pretty quick that they're going to do more later.
I always say we have a crystal ball, and at the end of the day, we'll see what the market does.
Let's add another brilliant voice to that mix. Adam Posen of the Peterson Institute writes the following. If they go 50 instead of 25, is it a big mistake? Probably not in terms of short-term damage to the economic outlook, but it does further undermine the Fed's communication. As you saw, Adam is with us now. Adam, thank you so much for joining this morning. So let's start there. Why is going 50 an issue of credibility?
I think, Danny, thanks for having me, and Fed Day. I think what's going on is we're seeing the culmination of months of the Fed shortening and shortening and narrowing the justifications they use for their decisions. So we've gone from a world where they were talking about a 2-year ahead forecast, which is what inflation targets generally do, and talking about multiple factors, to a world where in Chair Powell's Jackson Hole speech, he was talking just about the unemployment rate and just about the real Fed funds rate and just about the next 3 months. And so then you become what former Bank of England Governor Mervyn King used to call a hostage to fortune. So we got a unemployment number that came down last month. And even though it was totally expected that it would come down last month, everybody's like, oh, does that mean the Fed's changing? Does that mean the Fed's doing this? Does that mean the Fed's doing that? It never should have been so dependent on one piece of data. And so I don't understand all the drama, but I do understand that whether they do 25 or 50, the real problem is going to be how they say contingently, depending on how the economy goes, what are we going to do? Whereas what they keep saying is they're basically locked in, which I think is a mistake.
So what do you want to hear from Powell today, Adam, then, to clear some of this up, to get to the kind of scenario that you're talking about?
I don't think realistically we're going to hear it from him today. I think it needs the committee changing the dots or making a broader statement or having Powell read out a broader statement, which is not going to happen. And if they just say data dependence, that doesn't help, because the point is we don't know, or the Fed doesn't know, whether the monetary policy really is that tight. A lot of people are saying they're a long way from neutral. Well, they're a long way from neutral, but credit conditions are pretty darn easy, especially after the Fed raised 500 basis points. And the fact is, R-star, which is the benchmark, the abstract, unmeasurable benchmark for where policy should be in a full employment economy, has probably gone up. So the Fed policy is probably not that tight. At the same time, there are a lot of things going on in the labor market that are not just captured in the unemployment rate. So they would have to go out and go back to something like the way Yellen used to talk about a labor market dashboard, instead of just saying unemployment rate's going up.
To that point, you have a credit market that is still, spreads are really tight, as you mentioned. You have equity markets just around an all-time high. Just to get to the 50 basis point thing, the last few times we've had this, it was COVID, it was a credit market implosion, it was a stock market implosion, 2001, 2007, 2020. Does it set some different sort of precedent of what it means to do a big-sized cut? If that's what they do this time, is it a different transmission mechanism and response mechanism, rather, that we're dealing with from this Fed?
You're absolutely right, Danny. They would mean a different context, at least, and a different conditionality for what takes a big cut. Now, it's perfectly fair to say they raised rapidly so they can cut rapidly. There shouldn't be an asymmetry, but that means they have confidence in their forecast that they're pretty sure they need to cut a lot and quickly, and they haven't communicated that. And I don't think that's the right forecast, frankly. It might be right. I think you can argue this risk management, that inflation is on a downward path for the moment, and so the relative risk of being wrong on a recession versus wrong on inflation goes the way of cutting. But that's a different statement than saying, oh my God, we have to get cutting and we have to lock in the expectations that a year from now we're going to be down 200 basis points. And that's where I think the real problem is. They're so focused on the short term when there's no clear proximate cause of short-term problem, like you just said, which usually is the justification for a big, fast move.
I was going to say, Adam, is it a problem that we're even having this debate, that we're coming through a past couple days where we're talking about reading tea leaves from Colby Smith and Nick Timmeros, that we're trying to decipher things like retail sales to get an idea? Is it a problem that we're even at this point to begin with?
I think it's a reflection of an underlying problem. I mean, my personal forecast is they're going to do 25, and these news stories are going to turn out to have just been speculative news stories. We'll see. But the fact is, there shouldn't be this much uncertainty about what the Fed is considering. So if it is just the unemployment rate, and that was all, and the Fed funds rate, the real Fed funds rate, which was all Powell talked about in his Jackson Hole speech, then it's pretty straightforward, and it's weird that it's up in the air. If, on the other hand, as it should be, it's a more contingent, more nuanced forecast, then they have to explain why it's on this sort of tenterhooks and every little bit of data counts. This is not where you want to be as a central bank. You don't want to be having everyone sort of saying, what are they going to do next? I don't care if they disappoint markets. I don't care if they surprise markets. So, you know, in 2022, 2023, they surprised markets by continuing to hike when the markets were not expecting it. And that was the right thing. Listen to what I say. We'll keep going. But that's not what they're doing here. If that is what they're doing here, they should just go for it.
I say, if Powell can't be bullied, Powell & Co., by the 16th largest U.S. bank collapsing, then they probably shouldn't be bullied by a couple of bond traders trying to price in 50 basis points.
Well said.
Adam.
Well said, Danny.
Thank you. Thank you, Adam. And just for that, you can stick around. Adam Posen is staying with us. Okay, coming up, we're going to talk about the geopolitics. Hezbollah is now pointing the finger at Israel. Thousands of pagers exploded across Lebanon, leaving almost 3,000 injured. We're going to catch up with our Middle East reporter next. It's your Bloomberg Brief. Danny Berger in New York. Hezbollah has accused Israel of orchestrating coordinated attacks in Lebanon, which killed several people and wounded almost 3,000. Pagers, which Hezbollah members have been using to communicate, exploded across the country. Israel is yet to comment on the attacks. For more on this, let's go to Bloomberg's Jomana Bersecci. Jomana, what do we know at this point?
Yeah, really remarkable story, Danny. So this all unfolded at around 3:30 p.m. local time yesterday. What happened is these pagers that were handheld by many people in the Lebanese public, including many members of Hezbollah, simultaneously exploded. On the back of that, per the Lebanese Health Ministry, 2,800 people were injured, 200 of them in a serious critical condition, and several others were killed, including a child. And also of note is that the Iranian ambassador also appeared to have been injured in one of these explosions as well. The Iranian embassy tweeted out earlier that he is recovering well. Now, both Hezbollah and the Lebanese government were quick to point the finger at Israel. The Lebanese Prime Minister Najib Mikati said this is an infringement on Lebanon's sovereignty, but Israel themselves have not said anything. They have declined to comment on the events of the last 24 hours. But of course, one of the major questions is, why were Hezbollah operatives using these pagers in the first place? And this goes back to a directive that the chief commander Hassan Nasrallah gave back in February, where he said and warned military operatives to move away from using their mobile phones because of risk of an interception. But of course, you fast forward to today, and this is the result. This is an extreme breach of security for Hezbollah, the biggest in history, per a spokesperson.
Jomana, so much about fear in this conflict has been one of escalation. So what's next?
And that is the big question. Lebanon is on a high state of alert. There is a lot of paranoia. Many people have chosen not to wear their smartwatches today because of the sensitivity about the geo-tracking system in some of these devices. There is a fear that this operation lays the foundation for a future bigger operation coming out of Israel. And of course, there's another dimension to this, which is that the war has turned from a hot war and the daily exchange of crossfire across the border to cyber warfare now, which is a war of a completely different level. What we are hearing from the Israeli side, not vis-a-vis the operation itself, but vis-a-vis their war objectives, is yesterday Netanyahu said that there is now going to be a new war objective in that they want to reclaim security on their northern border to allow for Israeli citizens to return back there to their homes, which means that there is going to be a renewed emphasis on securing that border. What that means in practice is unclear at this point.
Jomana, we really appreciate it. Bloomberg Horizon's Middle East and Africa anchor, Jomana Bersecci. Now, politics closer to home. We are less than 50 days away from the election. Mail-in early voting has already begun in some states. Adam Posen, president of the Peterson Institute, I'm pleased to say, is still with us. Adam, we were just talking moments ago about the Fed's decision today. I want to know about a month from now, when they'll have to make a decision the day after an election, and considering recent history, we might not even know who was elected at that point. What does it mean to be setting monetary policy around such uncertainty?
Here, I think the Fed has gotten one thing importantly very right and one thing not so right. The important thing under Jay Powell's leadership is they have said they're going to be the fair umpire. They're going to do the right thing for the economy, irrespective of the election. Obviously, people cutting rates this close to an election, they are at risk of being accused of playing politics. I believe they're sincerely just trying to do the right thing for the economy. And so they're not going to be afraid. We were just joking about being bullied. They're not going to be afraid where there really is a bully to do what they think is the right call in November. Where I think they're missing a beat, and I wrote about this before Jackson Hole in the Financial Times and talked about it on Odd Lots with your colleagues, is that we know, whether it's Harris or Trump, that there's very likely going to be extremely further loosening in fiscal policy. And it's going to be much larger and more irresponsible under Trump than Harris, but either way, there's going to be a loosening. We know that whether it's Harris or Trump, there's going to be increased tariffs. Again, it's going to be much worse, much bigger under Trump than under Harris, based on what they've said, but there will be additional tariffs on China and Mexico either way. So there is going to be inflationary pressures by the time we get to second quarter of 2025. And it would be good if the Fed, in a nonpartisan way, admitted that they cannot commit, as they keep seeming to do, to being on a long-standing path of easing through 2025, given these realities.
Adam, just to be clear, and by the way, that Odd Lots episode was wonderful. I think you used the phrase rifle shot to describe Powell's his speech at Jackson Hole, which was just perfect. But so just to underline what you're saying, whether it's Trump or it's Harris, are we going to be in a situation where mid-next year the Fed either needs to stop cutting or even hiking, regardless of who's president?
In my view, yes, with a high degree of confidence. I think if it's Harris, they'll have to stop cutting, and if it's Trump, they'll have to start hiking, based on what the policy statements and the party platforms are. And, you know, I'm 65, 70% sure they're not going to do the 100 basis points currently priced in for 2025. Whether or not they're going to hike is contingent on whether Trump wins, but either way, I think it's wrong for the Fed to just pretend the future isn't going to happen. I think it will be right for them to reverse, but I think it would be good if they said, in a nonpartisan way, that possibility is there.
But Adam, I got to be honest, like, how do they actually do something like that? Because, you know, if they start talking about tariffs, people are automatically going to say, okay, the Fed is going after Trump with a presidential nominee who's already threatened the Fed's independence, not directly, of course, it's been according to reports, but there's already just so much contention over this issue.
I think Trump has directly threatened the Fed independence. It's not according to reports. He said he wants a say as president over monetary policy, which your Bloomberg colleague David Wilcox has written about, is a direct threat to Fed independence. But anyway, leaving that aside, this is why the Fed people were not happy with my writing or talking about this. Not that they care that much what I say, but to the degree they care. And I understand that their instinct is, let's just shorten the time horizon, let's just try not to offend anybody, let's just try to keep it narrow. But I think it puts them, all that does is move the awkwardness, you know? So it doesn't, in the end, make things better. I think, and central banks cope with this all the time. Central banks in developing countries where the politics is what the U.S. politics, unfortunately, is increasingly looking like, largely due to Trump, is going to be much more uncertain, much more unstable, and the central bank has to be an anchor, and it doesn't fulfill its role as an anchor if it just sort of keeps its head down.
Adam, away from the Fed, we are in this period where you have a grab bag of policies being thrown out there by the candidates, from tariffs to deportation, and then from Harris, you have things like small business tax credits, promoting home building, supporting first-time home buyers. As you dig through the details, putting aside the likelihood of some of these things actually being passed, are you hearing anything that you think would be beneficial at this point in the cycle?
Oh, there's a lot out there that's beneficial. You were talking with Anne-Marie, I think, before I came on about the SALT deduction and some of these other things. And I don't know if either of you said it. I mean, Trump's like, you know, the old Oprah joke, right? You get a car, you get a car, you get a tax cut, you get a tax cut. Harris is less so. I mean, it's a meaningful difference. But, you know, the key question is, as Reagan said, as Biden said, is it spending to increase supply? Is it investment, or is it spending just for spending? Similarly, tax cuts. Is it tax cuts to increase investment, or is it just tax cuts? And that's the criterion you got to look through this. And some of the things that Harris is talking about continue to build up supply. There are a few things Trump is talking about that build up supply, but mostly not.
Okay, Adam, we're going to have to leave it there. Thank you so much for joining this morning. It is always a true pleasure to speak with you. Adam Posen of the Peterson Institute. Okay, coming up, Gas Tech Conference is in full swing in Houston, Texas. That's why your very own Manus Cranny isn't here. We're going to bring you his discussion with energy executives next on your brief. It's Bloomberg Brief, Danny Berger in New York. The 2024 Gas Tech Conference is underway in Houston. The gathering brings together energy industry leaders to discuss energy transition and how to deliver on global net zero goals. Manus is there now. He moderated a discussion with the top players in LNG.
At a high level, actually, we're very strong believers in the role of LNG, and we've got a deep belief as well that the world has the capacity to absorb more LNG. And you only have to look to some of the nations around the world. We're an Australian headquartered company, so the bulk of our customer base is in Asia. And when you look at what's being done in places like Japan, Korea, and China, and I'm sure Connie-san can speak to what he's seeing in Japan, we see continued appetite for more LNG. We see this reflected in contracting behaviors, so we're seeing long-term contracts being signed from customers in Asia. We see this in the construction of new import terminals. And, you know, when we get asked this question about this LNG glutton, are we worried? We actually look back at history, and there have been forecasts of LNG gluts a few points in the past, and none of them have come to pass because the reality is the market is hungry for this source of fuel. Now, if I can just connect as well to the energy transition conversation, one of the things that I think we all need to recognize is the imperative to tackle emissions. And when gas is used in lieu of coal for power generation, it's got half the life cycle emissions intensity. Now, the total global LNG market today is equivalent to about 12% of coal use. So there's a lot of room for us actually to grow the LNG market, to provide that reliable energy, provide that affordable energy, and tackle climate change.
That was the CEO of Woodside Energy speaking at the Gas Tech Conference in Houston. She was speaking there with Bloomberg's Manus Cranny. And later today, Manus will be moderating a conversation with the former Secretary of State, John Kerry. Focus will be on climate cooperation and energy security. You can follow that panel. Live Go is where you want to head on your terminal. Okay, let's get you set up for the rest of the day. U.S. housing starts and building permits data, that comes out at 8:30 a.m. Eastern. Then is the main event, a Fed rate decision at 2 p.m. That will be followed by Chair Powell's news conference. Tune in to all of that at the Fed Decides today. The surveillance team will walk you through it at 1:30 p.m. Just to give you an update of where markets are pricing things, we're currently at 60% odds that they will cut by 50 basis points. Wow, so 60% odds that they'll cut by 50 basis points. That's actually moved up as the show has gone on. Euro versus the dollar, you can see just dollar weakness across the board. We're playing defense ahead of that Fed decision. Your euro versus the dollar at 113. Dollar yen, that's at 141 after earlier this week going below 140. Bloomberg dollar spot as a whole is weaker by 0.2%. So 111 on your euro versus the dollar. That's where we stand. Kit Juckes talking about a weaker dollar, just given that the Fed has more room to cut. Okay, that's it for Bloomberg Brief. Surveillance, that's up ahead. This is Bloomberg.